name is Matshidiso Malgas. I'm an analyst at FSCA within the Investment Providers Department. With me, I am joined by my colleague, Judith Maisela. She's also from the Investment Providers Department. Together, we are responsible for supervising investment providers. But for these purposes of this webinar, we'll be looking at all FSPs that must comply with the liquidity requirements. So I'll be handing over to my colleague Judith to give us the background and the purpose of this webinar. Thank you. Over to you, Judith.
Thanks, Matshidiso. So welcome once again to everybody who's viewing this webinar. We will be taking you through today's webinar that relates to liquidity requirements. So as a start, I just want to outline the topics that will be covered today. We will go into the background and purpose of today's webinar. We will then go into the applicable legislation. After that, we'll look into the financial statement submission. We'll also look into the definitions of category 1, 2, 2A, 3, and 4 FSPs. We'll also be looking into the definitions that relate to liquidity requirements as outlined in section 47 of the Board Notice 194 of 2017. We'll then also look into the general requirements for FSPs. We'll look into financial soundness requirements, which relate specifically to liquidity requirements. We'll provide an illustration of a liquidity calculation that deals with the liquid assets as well as the annual expenditure. Further to that, we'll also go into the Annex 6 Form A, which is the liquidity declaration form, as well as together with Matshidiso and I will be going through the remedial actions analysis where an FSP does not meet Chapter 6 requirements. And then lastly, look into other important matters to note when taking into account liquidity calculation. So as a start, let me just provide a brief background of why we are here today. So the Financial Sector Conduct Authority conducted a financial soundness survey sometime last year in 2022. And after analyzing the results of the survey, the authority saw a need to clarify some of the issues or other concerns that were noted on the survey. And we are doing this through such webinars. So the purpose of this webinar today is to provide clarity on the identified concerns, which one of them includes liquidity requirements as prescribed in section 48, subsection 2 of the determination of fit and proper requirements, which is also known as the Board Notice 194 of 2017 as amended by the Board Notice 707 of 2020. So as a start, let's go into the applicable legislation and to whom this legislation that we are looking into today applies to. So we will be looking into the Financial Advisory and Intermediary Services Act 37 of 2002, and particularly into Section 19 of the Act. We'll also be looking into the Board Notice 194 of 2017 as amended by the Board Notice 707 of 2020. This is also known as the determination of fit and proper, and we will be using those words interchangeably. We will be looking into section 48, subsection 2, which deals with liquidity requirements. And we'll also be looking into section 48, subsection 3, which looks into the Annex 6 Form A liquidity declaration form. Further to that, we'll look into the FSCA FAIS Notice 46 of 2019, which talks about the Section 19.3 report for FSPs that collect or hold client assets. So all the legislation that I've just mentioned above applies to a Category 1 FSP that holds or receives premiums or other monies in respect of a financial product, and it also applies to a Category 2, Category 2A, Category 3, and 4 FSPs. This, however, does not apply to key individuals and representatives who are natural persons, as well as registered banks and insurers that are now under the jurisdiction of the Prudential Authority. Moving forward, so let's just go into the financial statement submission as prescribed in Section 19 of the FAIS Act. These are the accounting and audit requirements, which then requires that FSPs must maintain full and proper accounting records on a continual basis and brought up to date monthly. The second requirement is that an FSP must annually submit audited financial statements, which comprises of the balance sheet, the income statement, the statement of changes in equity, as well as the statement of cash flows, together with its notes. With this, we will also, the audited financial statements also need to be accompanied by a Section 19.2 report, which is referred to as the Independent Auditor's Report. And for FSPs that collect premiums or hold clients' funds or assets, also need to provide a Section 19.3 report, which is referred to as an Independent Auditor's Report on a separate account. So the audited financial statements must be submitted by the FSP to the authority not later than 4 months after the financial year end of the FSP. For FSPs that are collecting short-term premiums, there is a FAIS Notice 123 of 2017 as amended by the FAIS Notice 87 of 2019, which exempts certain FSPs from submitting the Section 19 report and liquidity requirements. And one of the conditions to the exemption is that an FSP must submit their insurer mandate with their annual financial statements every year. So now that we've covered, let's move on to the next item, which is the definition of the different categories of FSPs. We have a category 1 FSP, and this is an FSP that renders financial services other than the financial services mentioned in category 2, 2A, 3, and 4. So this FSP is authorized to provide advice, render administrative services to other FSPs, and or whether the applicant will be rendering intermediary services in respect of the relevant subcategories of financial products. And then we also have a category 2 FSP, and this is a discretionary FSP, which is often referred to as an investment manager or an asset manager. So this is an FSP that renders intermediary services of a discretionary nature in respect of the choice of the financial product. We also have a category 2A, and this is a hedge fund manager. So this is a type of FSP where it is a hedge fund FSP that renders intermediary services of a discretionary nature in relation to the particular hedge fund or fund of hedge funds in connection with the particular financial product. We'll then continue still with the definitions of the different categories. We have a category 3 FSP, which is also known as an administrative FSP or LISP. LISP are also referred to as linked investment service providers, and these are FSPs that render intermediary services in respect of a financial product through the method of bulking. So bulking means the aggregation of client funds when buying or investing in financial products on behalf of clients and the subsequent allocation of such financial products separately in the records of the FSP. Lastly, we have a category 4 FSP, and this is an assistant business FSP that is an FSP that renders intermediary services in relation to the administration of assistant policies on behalf of the insurer to the extent agreed to in terms of a written mandate between the insurer and the assistant business FSP. So moving right along, I will be taking you through the definitions that are defined in the board notice that specifically relates to liquidity when we are calculating liquidity. So the first definition relates to annual expenditure. It is defined in the board notice as the expenditure set out in the latest set of financial statements of an FSP, or in case of an applicant commencing business, the budgeted expenditure as expressed in the budget of financial accounts. So that annual expenditure, you less or deduct or subtract staff bonuses, employees and directors, partners or members share in profit, emoluments of directors, members, partners or sole proprietor, other appropriation of profits to directors, members, and partners. You also list the remuneration that is linked to a percentage of the FSP's revenue or a percentage of the revenue generated by an employee, representative, or contractor of the FSP, and that in the absence of such revenue that we have mentioned above, the FSP has no obligation to pay the remuneration. You also list depreciation, bad debts, and any losses resulting from the sale of an asset. So we'll move on to the second definition, which is cash, and it's defined in the board notice as well, but also amended by the board notice 707 of 2020. So cash is defined as a physical currency consisting of reserve bank notes and coins, any balance in an account with a bank as defined in section 1, subsection 1 of the Banks Act, a branch of a bank or mutual bank as defined in section 1, subsection 1 of the Banks Act, or a bank established in a country other than the Republic and which lawfully conducts in such other country a business similar to the business of a bank, excluding a facility that extends credit. So the last definition that we'll be looking into is the definition of liquid asset. So liquid asset, as defined in the board notice, it compromises of cash which we've just defined above. It also compromises of a participatory interest in a money market portfolio. We also take into account 70% of the market value of a participatory interest in a collective investment scheme, other than an investment in a money market portfolio or CIS hedge fund. We also take into account 70% of the market value of a security listed on a licensed exchange, provided that it does not constitute more than 50% of the total liquid assets. We'll still continue with the definition of liquid assets, where it says that the assets referred to in paragraph A and B, which we talk about the cash as well as the money market portfolio, are capable of being converted without any penalty on capital in terms of the conditions of this asset into cash as follows: 50% of it within 7 days, and 50% of it within 30 days. And then the assets that are referred to in C and D, which are the listed securities as well as the CIS, are capable of being converted into cash within 7 days. So this is where I will stop. I will then hand over to Matshidiso, who will take us through the remaining of the webinar. Thank you so much. Over to you, Matshidiso.
Thank you, Judith. That was quite a detailed analysis of the explanations or definitions that you gave from the fit and proper requirements. So moving along, we'll be looking at the general requirements. So what are the general requirements for FSPs in terms of the fit and proper requirements? So the first requirement is that the assets of an FSP must exceed its liabilities at all times, and that an FSP must maintain financial resources that are adequate to carry out their activities and meet their liabilities as they fall due in the ordinary course of business. So for those FSPs that collect premiums, they are required to have strategies, processes, and systems and financial resources to cover its risk and exposure. So what we mean by this, we mean that for FSPs that collect premiums, they must have processes for collecting those premiums, processes being that they must maintain separate bank accounts for the client premiums that they collect. So the client premiums must not be integrated with the FSP monies in the bank. They must account for them separately in a separate bank account. So further on, we will be giving you an explanation of who may not become or continue to operate as an FSP? And when will that be? So for an FSP that has been declared insolvent or provisional insolvent, they may not continue or become an FSP. Also for an FSP that has been placed under liquidation or provisional liquidation. So an FSP also that is subject to proceedings that lead to the above may also not continue or become an FSP. So where serious or where an FSP seriously or persistently fails to manage their financial obligations, they may also not continue or become an FSP. And if any of the above lead to business rescue proceedings, where business rescue proceedings have commenced, such FSPs may not continue or become an FSP. Thank you. So the next slides, it will be detailing what the financial soundness requirements are. So what are financial soundness requirements? So the FAIS Act explains what financial soundness requirements are for FSPs, and is also contained in Chapter 6 of the Fit and Proper Requirements, that is Board Notice 194 of 2017. So what Board Notice 194 of 2017 requires of FSP is that FSPs must meet their financial soundness requirements at all times. So what are these requirements? So there's requirements which are considered specific requirements in Section 48 of the Fit and Proper Requirements. And these are called the additional asset requirements, the working capital requirements, and the liquidity requirements. So for the purpose of this webinar, we will be concentrating more on the liquidity requirements. So in addition to the financial soundness requirements, there are certain documents that must be submitted along with the financial statements. So these are the independent auditor's report, which is a requirement in terms of Section 19.2 of the FAIS Act, and also the independent auditor's report on separate accounts, which must be submitted in terms of Section 19.3 report. So this is a report for FSPs that collect client premiums or FSPs that hold client assets. So another submission that must come along with the financial statements is Annexure 6, Form A, which is the liquidity calculation declaration. So this Form A, Annexure 6, must be submitted at different intervals for the different FSP license categories. So for the category 1 FSP that collect premiums and category 4 FSP, they must submit this declaration simultaneously when they submit their financial statements once. So it is submitted only once a year when they submit their financial statements. And for the rest of the FSP categories, such as the category 2 FSP, category 2A, and category 3 FSP, this declaration must be submitted biannually based on the FSP's financial year end. So this declaration must reach the FSCA within 45 days after the financial half year end of the FSP. So whereby an FSP requires an extension to submit this declaration. So the extension, the request for an extension must reach the FSCA within 15 days prior to submission date. So the slide then will be looking at an example, as previously Judith took us through the different definitions in the fit and proper and where each definition fits. So this slide, it displays how the liquid assets are calculated. So from what we can see on this slide, from row one is cash. So what is considered to be cash in the calculation of liquid assets? So what's considered to be cash is cash that is capable of being converted without a penalty on capital into cash within 7 days, and also capable of being converted without a penalty on capital into cash within 30 days. So if any of the assets that an FSP has cannot be liquidated within 7 or 30 days, that will not be considered as cash. Secondly, what do we consider as liquid asset? Row 2, what we consider to be liquid assets are 100% of the market value of a participatory interest in a money market portfolio. And these must also be capable of being converted without any penalty on capital into cash within 7 days. And also those that can be converted without a penalty into cash within 30 days. Same as this one. If an FSP has any market value of participatory interest in a market portfolio that cannot be converted to cash within 7 or 30 days, those are not considered to be liquid assets. Number 3, row 3 rather, what is also considered to be liquid asset is 70% of the market value of a participatory interest in a CIS other than a participatory interest in a money market portfolio. As stated above, those are included 100% market value of those. So we include 70% of the market value of a interest in a CIS other than money market portfolios or CIS hedge funds, provided that the interests are capable of being converted into cash within 7 days. So the 70% must be capable of being converted into cash within 7 days. And also the market value of securities listed on a stock exchange, provided it does not constitute more than 50% of total liquid assets. So all of those are added together to give us total amount of the FSP's liquid assets. Thank you. And then what do we consider to be annual expenditure? Again, Judith gave the definitions of what annual expenditures are. Looking at this calculation and where do we fit in the amounts? So what is total annual expenditure? What amounts should come here that are considered to be annual expenditures? So, and where do these amounts come from? So these amounts will come from the income statement or the statement of profit and loss, and also will be disclosed to the notes to the financial statements. So what is total annual expenditure? It includes cost of sales, finance cost or interest expense, and operational costs, which are operating expenditures and administrative expenditures. So from the total annual expenditure, we take out or deduct staff bonuses, employee and directors, partners, members' share in profits, and we also deduct emoluments of directors, members, partners, or sole proprietor. And we also take out any other expropriation of profits to directors, members, and partners. And what also would take out from your annual expenditure is remuneration. Which remuneration is this one? So we take out a percentage of the FSP's revenues, remuneration, for example, commission, which is based as a percentage of the revenue from the rendering of financial services. What other remuneration do we take out or deduct? We deduct remuneration that is generated by employees, representatives, or contractors of the FSP. And what is of importance is that in the absence of such revenue being generated by the FSP would have no obligation to pay that remuneration, and hence that remuneration is being deducted from the total annual expenditure. So also what we need to take out is depreciation, being a non-cash item, bad debts, and any loss resulting from a sale of an asset. So together, all of those amounts that we have deducted from the total annual expenditure as shown in row 6 would give us the total adjusted annual expenditure in row 15. So this amount then will need to compare it with the amount we got from the previous slide, that is the liquid assets. But we don't include this whole figure as liquid assets. We don't compare this whole figure against liquid assets. We need to calculate what we consider to be a comparison to the liquid assets, depending on the FSP's license category. So for this particular FSP, they use 8/52 weeks of the total annual expenditure. The reason being, this is a CAT 2 FSP, the example that was used here. So hence we used the 8/52 weeks. So when you take the 3 million divided by 52 weeks, multiply by 8, that it would give us that 499,754, which is considered to be the annual expenditure. And by saying that, we can say that that amount is less than what the liquid assets of 3 million were from the, sorry, of 2 million were from the previous slide. Thank you. So as can be seen from this table, the different methods and forms of calculating what liquid assets should be for the different license categories. So for a CAT 1 and CAT 4, the liquid assets should be equal to or greater than 4/52 weeks. So that adjusted total annual expenditure will be multiplied by 4 divided by 52 weeks for a CAT 1 or a CAT 2. And for a category 2, as shown from the example, it was the liquid assets should be equal to or greater than 8/52 weeks of the annual expenditure. So hence we multiply by 8 and divide it by 52. And for a CAT 2A FSP, the liquid assets must be equal to or greater than 13/52 weeks of the annual expenditure. And for a CAT 3, the liquid assets must be equal to or greater than 13/52 weeks of the annual expenditure. So of also importance is knowing who should complete this form. So this form must be completed by a key individual of the FSP. And this declaration must be signed by the Chief Financial Officer of the FSP or an equivalent person. Thanks, Judith. Okay, Judith, let's go through this slide. So this the slide 11, then it speaks about remedial action analysis where FSPs do not meet the Chapter 6 requirements. That is where FSPs do not meet the liquidity requirements. What should happen when FSPs do not meet the liquidity requirement? So number one, when FSP does not meet the liquidity requirements, they need to submit a copy of their latest management accounts to the FSCA. So these management accounts must be submitted at the same time as the submission of the financial statements or at a later date where FSPs can foresee that they will not be able to meet their financial soundness requirements. Also, when do when do they need to submit? What also do they need to submit? They need to also to submit if the financial soundness requirement is not met on these management accounts. The FSP needs to submit a copy of the remedial plan. So what is this a remedial plan? So a remedial plan is an action plan that will show how the FSP plans to re-establish its financial position to meet the financial soundness requirements, and also how this plan should include the steps that the FSP will take, and also must include the timeframes that the FSP will take to resolve the non-compliance and to ensure that it goes back to complying with the financial soundness requirements. So what does the remedial plan include? So this plan must include the strategy or initiatives that the FSP will focus on in achieving the financial soundness. As also stated, timeframes it will take for the FSP to meet the financial soundness, and must also include the specific income statement items the FSP will focus on in order to increase their profitability and inherently their owner's equity or financial soundness. So they must be specific in their remedial plan as to which specific expenses they will focus on in order to increase their profitability, or whether if they will be earning more revenue in increasing their profitability. These need to be stated in the remedial action plan, and they need to be specific with timeframes. So the remedial action plans must be implemented and be evident in the next financial statement submission. So when we receive the financial statements in the next submission, we need to be able to see that the FSPs have implemented the remedial action plan that they had provided us with. Thank you. So the last slide, then other important matters that FSPs need to consider when calculating liquidity calculation or when signing and submitting the liquidity declaration. So as part of the annual expenditure, as previously shown on the example, that it is important that FSPs must include the correct amounts there, such as the cost of sales, the operational cost, and finance cost. And it is important that commission must be deducted from the annual expenditure. That is commission paid to employees or to representatives for rendering of financial services, as this is linked to a percentage of the revenue. Please do not exclude commission. We see that in most cases, FSPs exclude commission from remuneration. So also remuneration for purposes of the definition of annual expenditure, it also includes fees and any other payments paid directly or indirectly by an FSP to contractors for the rendering of financial services. These would include admin fees or administration fees for rendering of financial services. These needs to be included as part of remuneration and deducted from the annual expenditure. What is also important, what we've also observed, is that FSPs, they include debtors or receivable as part of liquid assets. So in terms of the definition of liquid assets, it is specific that debtors are not included there. They are not liquid assets as defined in Board 194 of 2017, so should not be added as liquid assets. And also guarantees, securities, pledges, and overdraft are not accepted as liquid assets as defined in Board Notice 194 of 2017. These should not be included there as they are credit facilities and are not considered to be liquid assets. Thank you.
Thank you so much, Matshidiso. I think that was very insightful. And you have given us other important matters to consider when when calculating liquidity requirements. So I think this brings us to the end of this webinar for today. Once again, thank you to everybody who has joined this webinar, and we then wish that you have a great day further. Thanks and goodbye.
Bye. Thank you.